Short-term equity investments, these are current assets. We're going to be talking about trading securities, or abbreviated TS, and available for sale securities, abbreviated AFS. So let's get started. When an investment is classified as current, it must meet two criteria. First, it needs to be readily marketable, meaning it's on the New York Stock Exchange, the NASDAQ, the over-the-counter, the American Stock Exchange, but it has a market and you can tell what its price is, or what people are willing to pay for it at any point in time. That's what readily marketable means. The second thing is that the management needs to intend to convert that investment into cash within the current asset cycle, which is generally around a year. So if it meets those two criteria, it can be either a trading security or an AFS. So let's look a little deeper. Well, a trading security is also known sometimes as short-term investments, and available for sale securities can also be called marketable securities at times. But AFS can be current or long-term depending upon management's intent, and they don't have to declare that intent till the last day of the year. And you're saying, well, what's the big deal? Well, just wait, you'll see. So what are the basic entries for trading securities and available for sale securities? When you buy, it's basically debit. Trading securities are available for sale securities for the number of shares you acquire times the cost of those shares, and credit cash for the number of shares times the cost. When there is a dividend declared on those stock, there are 3 dates that you need to be aware of. The first date is the date of declaration. That's when the corporation says, hey, if you own these shares of stock, we're going to pay you a dividend, and it can be a cash dividend most likely. And on the date of declaration, when they issue that press release, it's debit dividends receivable, which is a current asset account, and credit dividend income, which is a revenue account. The second date that's important is called the date of record, which means if you own the shares on the date of record, you will receive the dividend. The day after the date of record is sometimes known as ex-dividends, which means excluding dividends. You're not going to receive the dividend because you don't own it on the date of record. And when the checks get sent out in the mail, that's called the date of payment, where we debit the cash and credit the dividend receivable. Sometimes these 3 dates are collapsed into one, where they say you declared and paid a dividend. If a dividend is declared and paid on stock that you own, a lot of times you'll just debit cash and credit dividend income. And finally, when you sell, whether it's a trading security or an available for sale security, you're going to debit cash for the number of shares you sell times the sales price. You're going to credit trading security or available for sale security for the number of shares times its basis. It's probably not what you paid for at its cost, but instead, remember, trading securities and available for sale securities get marked up or marked down to their market value the last day of the year. So it'll be the difference between the sales price and the marked to market basis for the last time you adjusted the value of the securities. Now let's see if we can do some. It says we have Monroe Auto Supplies. These securities are all classified as trading securities. So if I purchase 1,000 shares of IBM, I'm going to debit trading securities because I'm not going to keep these securities but just for a short while. So I really don't care what is in my trading security portfolio, whether it's IBM or something else. It's just I bought it because I think it's going to go up in value, and then I'll sell it again. So I'm going to debit trading securities, and I'm going to credit cash for the 1,000 shares times $50 a share, which is $50,000. If I purchase 500 shares of GM, again, because it's a trading security, I'm just going to debit trading securities for the 500 shares times $80 a share, which is $40,000, and credit cash for $40,000. If I sell 750 shares of IBM, since all of this is taking place before I head to market, I'm going to debit cash for 750 shares times $60. I'm going to credit trading securities for 750 shares times what's it on our books at right now? Well, it's on our books at $50 a share. So 750 times 60 is 45,000. And 750 times 50 is 37.5. I look at this and say, well, that entry doesn't balance. I need another credit. So when I have a sale and I need a credit, I know that that's a gain on the sale for the difference. And the gain on the sale is $7,500. And then in number 4, where it says we receive a dividend of $1.50 a share from GM, assume declared in a previous period, which means we've already done the debit dividends receivable, credit dividend income in the previous period. So now what I'm going to do is I'm going to receive the cash and get rid of the dividend receivable. So I'm swapping one current asset for another current asset. And we have 500 shares of General Motors, and we're going to get $1.50 a share. So that would be $750. So I'm going to debit cash $750, credit dividends receivable $750, and remember the reason we're making this entry is last period I debited dividends receivable and credited dividend income. So notice the dividend income is in the year or the period that it was declared, not in the period that it was paid. So that's an important distinction. Well, let's see how you do on a few more of these. If we purchase 200 shares of Xerox stock for $40 a share, again, since it's a trading security, I'm just going to debit trading securities for 200 shares times $40 a share, which is $8,000, and credit cash, $8,000. If I sell the remaining 250 shares of IBM for $30 a share, I'm going to receive cash for 250 shares times $30 a share, which is $7,500. And I'm going to credit trading securities for those 250 shares. And what is the basis in the IBM stock? Well, since we haven't had a year end to market, it's what we paid for it, which was $60 a share. So as you can see, there has been a decline in value. So the credit is for $12,500, and now I need a debit. And when I need a debit in a sale situation, it's a loss on the sale of the securities for the difference, which is $5,000. So in number 7, when I sold 200 shares of Xerox, remember I paid $40 a share for them. So I'm going to debit cash for 200 shares times what I'm selling them for, $58 a share. And 200 shares times $58 is $11,600. And I'm going to credit trading securities for 200 shares. And what's my basis? Well, in Xerox, it's $40 a share, which was $8,000. And I see that I need a credit, so I'm going to have a gain on the sale for the difference, and that is $3,600 gain. When I sell 500 shares of GM for $60 a share, I'm going to debit cash for 500 shares times $60 a share, which is $30,000. I'm going to be crediting trading securities for those 500 GM shares. And, what was my basis in the GM? Well, if I go back and look at the last page, it was $80 a share. So 500 times $80 a share is $40,000. I can see I need a debit for $10,000. So when I have a disposal and it's a debit plug, it's a loss on disposal of $10,000. So in the last question, it says, what did these transactions impact on the net income? Well, all these gains and losses would show up on the income statement. So let's recap our gains and our losses, and then we'll find the difference. So going back to the last page, we had a gain of $7,500 in part 3 when we sold some IBM shares. We didn't have any dividend income because remember that was included in the previous year. In number 5, nothing. In number 6, we had a loss of $5,000. In number 7, we had a gain of $3,600. In number 8, we had a loss of $10,000. So when we look at this overall, I can see that I had gains that came to $11,100, and my losses were $15,000. So the net impact for the year, $15,000 minus $11,100 means we had an overall net loss of $3,900. And there's the answer again. The thing you need to remember is when there is a permanent decline in the shares, in other words, something terrible happens, and you think the stock is never going to recover, meaning it's permanent, then you immediately write that stock down to its lower value because you're not expecting it to recover. Now with COVID, yes, we had a big market decline in stock prices, but for the most part, they bounced back. There are a few that declared bankruptcy and some other things, so you would look at those to see if those are permanent market value declines or whether if they're going to bounce back in a year or so. So in such cases, write it down to the market value. Realize the loss immediately. It will reduce your net income this year. And that's true whether it's a trading security or an available for sale security.